Hello, this is Julius from Basic Financials. Today I'm going to talk a little bit about paying yourself if you've got a private limited company, LTD. So you might have already looked at the videos I've got previously on choosing between setting up as self-employed or setting up as a company. Now we're going to assume that you've set up as a company. You looked at that and you thought, yep, company's the one for me. Now, what's the best way of paying yourself out of a company? Now, I'll talk about the practical ways of actually physically paying yourself in a little while, but to start with, I'm going to concentrate on the tax side of things. Now, what you'd normally expect is if you're employed by a company, you'd be getting a salary. Now, if it's your company, you have a choice between how you pay yourself. You could pay yourself a salary, but you've also going to have shares in your company, which entitle you to dividends. So you can pay yourself dividends as well. Now, what's the best mix of those two things? I'll give you an example of how the tax works. Because remember, you've got corporation tax for the company's income, profits, and then you'll be paying yourself, and then you've got your personal tax. So let's say that your company makes profits and income. Let's ignore other expenses other than salary and dividends. The dividends aren't actually an expense, but you'll see what I mean in a minute. So £50,000 your company makes in income and profit. Let's say that you took a salary of £10,000. That salary is tax deductible for the company. So you could take £10,000 off the £50,000, arriving at a £40,000 corporation tax profit. So a profit subject to corporation tax. Now, tax rate at the moment is actually 19%, but just to make it easier, I'm going to say 20%, just to make the figures easier. So you would have £8,000, i.e. 40,000 times 20%, you'd have £8,000 corporation tax. It's important to note that you need to sort of keep that in the company, really. You don't have to, but the best thing is to keep it in the company so that you've got it available to pay it. So you've company's made 50,000 in income, you've paid yourself a salary of 10, and you've got 8,000 corporation tax. So what you've got left now to pay is £32,000. And you could pay yourself that in dividends. So if now your personal income is the 10,000 salary and the 32,000 in dividends, leaving £8,000 in the company to pay the corporation tax. I'm keeping things basic here. I mean, there's obviously reasons why you might not take all of that, because you might want the company to invest in some plant and machinery, so you wouldn't take all of that. Now, the reason I say that you should not take that £8,000 that's due to be paid for corporation tax is because if you did, it would leave you overdrawn. You would have taken more than the company is entitled to pay you, because the company can only pay dividends out of distributable profits. And you've got to take the tax into account in that. So if you take the tax as well, then you've taken more than you're entitled to, which isn't in itself a problem. But it does create issues with overdrawn loan accounts and interest benefits in kind and potential tax on overdrawn loan accounts. I won't go into all of that, but that gives you an idea of what's going on. Now, the exact amounts that are best to be paying, I'm going to assume you're a sole director. If you're a sole director, you're not entitled to something called an employer allowance which gives you £4,000 off the company's national insurance bill. I'm not going to go into national insurance just there at the moment. I'm just going to assume that you're on your own as a sole director. Now, the best for up to the 5th of April 2021, the best salary would be $732 a month for the year, and from the 6th of April 2021 to 5th of April 22, that goes up to $737 a month, and then you would pay that in salary. So that would use up some of your personal allowance. Your personal allowance is £12,500 at the moment, going up by £70 next year. that would use some of your personal allowance, and the rest of your personal allowance would be utilised against your dividends. So that 732 is about something like 8,700 or something like that. It's close to that. So you can see how much of your 12,500 you've got left. Now, if you pay dividends to the extent that your total income doesn't go over 50,000 for this last tax year, then your dividends would be taxed at 7.5%, except for the bit that you can still use your personal allowance again, and except for £2,000 dividend allowance, which gets taxed at 0%. The rest would be taxed at 7.5%. If you go over the 50,000 total income, then you start paying at 32.5%, so it's quite a bit more expensive on the dividends. It's still better than paying salary. Okay, that gives you an idea. Now, why that £732, £737? The reason is because that amount is what entitles you to a year of state pension, but you don't actually pay any national insurance. And it's the national insurance that is the saving here. Because if you paid yourself a salary above the £732 a month, then you would start paying 12% national insurance on whatever you get over that, and the company would be paying 13.8%. Not quite on that. Actually, you wouldn't start paying 12% straight away. You've got a bit more before you start paying 12%, but it's not much more. The company would start paying 13.8%. Sort of straight away from anything you get over the 732. So you can see that's quite a big hit. You've got 12% and the 13.8%, which is another cost that you're not having to do because you're paying dividends instead. It used to be even better than that because they introduced dividend tax about 4 or 5 years ago, I think. And before that, you didn't pay anything on your dividends, so it was better. But HMRC eventually sort of decided, no, we can't do this anymore. Now, practically, how are you going to do your salary? If you're going to pay yourself a salary as an employer, you've got to register your company as an employer. I've got a video about that, I think, somewhere. So what you'd need to do is call up or do it online, register as an employer. You'll get given 2 references, a PAYE reference and a collection reference. You need to set up a government gateway account if you haven't got one already for your company. You'd need to register to use online services and PAYE for employers specifically. Once you do that, you'll get an activation code in the post to register or activate that service, and then you can download HMRC's free software, Basic PAYE Tools, and put your company information in and your personal information in, and then you can do you have to do what they call real-time information submissions each time you pay yourself. So every time you do that 732 or 737 a month, you would enter that in and do a submission online over the internet to HMRC using that software. Now, you don't have to do the same thing for dividends, that's just on the salary part. Now, practically, the best thing if you've got a limited company is to set up a company bank account. You could pay yourself that salary and pay yourself additional amounts as dividends. You don't have to do that. What you can do is just take what you decide is a good amount to be taking. So on that, say if you've got that 32,000 plus the 8,000 salary or 10,000 salary, you could say, well, that's what my income's going to be. I'm going to split that between 12 and do that each month. And then, so you're not actually paying yourself that exact amount of salary or the exact amount of dividends. What you'll do is you will still return that amount as if you paid the salary, and that will form part of what you've drawn. And the rest of what you've drawn will be the dividends. And you could do yourself a dividend voucher at the end of the year saying that the company confirms that you've paid this amount of dividends for the year. And then when you do your personal tax return as a director, you would put your salary down and you'd put those dividends down along with anything else you've got going. Anyway, I think that's probably enough. I hope it gives you an idea. yeah, obviously you could have a situation where you've got more than one director, and things are slightly different there, because you could pay yourself a bit more salary because of that employer allowance I mentioned, where you get some national insurance back. It's not a huge difference, but there is a bit of a saving if you pay yourself a higher salary and suffer the employee's national insurance. But anyway, I think that's probably enough. And if you've got any questions or comments, please leave them in the box below. And like and subscribe, please, as usual. And I'll see you again for another video soon. Thanks for listening.